This is Chapter 8, Video 3. Let's launch. Greetings. And so in this class, what we're going to do is we're going to talk a little bit about some of the allowable child tax credit, dependent credits, some other tax credits that we've got. And then we're also going to explain how the underpayment in late filing and late payments are actually calculated. And to be honest, folks, this is probably one of the things you're going to deal with the most often, is because people are going to, they're going to file late, they're going to pay late, and they're going to have to deal with a lot of that stuff, and so they're going to expect us to explain it to them in order to better have a better understanding of what's been going on. Okay, so tax credits. Tax credits basically reduce your tax liability dollar for dollar, vice a deduction, which basically the value of the deduction, we have to take it and multiply it by the marginal rate of the individual taxpayer. In the case of tax credits, there's no multiplication. All it is that, if I have a tax credit for $600, I know that I'm going to save them $600 in tax. And so that makes it a lot easier, but it also makes it a lot more valuable in many cases. There are some times where you will see things that are listed as tax credits that they're not as valuable dollar for dollar as far as an expense goes as you would imagine. So for example, the dependent care expenses is a pretty good example of it. Most taxpayers that we're going to be dealing with at CPA firms, it's 20% of your expenses. So if you spend $3,000 taking care of your kid to go to after school care, you're only going to get a $600 benefit. Well, if your tax rate is at 24%, you see where the delta is between the 20 and the 24%. So you're actually not going to get as much of a benefit out of it as you would if you were given a deduction instead. Now, they do it as a credit because they want to make sure that it's set to a certain level. They don't want somebody's income increasing the amount of benefit that they get as a result of that. And so that's why they kind of do the things. Now, that said, if I had, again, and I've said this in class, I've also said it with some other people, if I have a chance between a foreign tax deduction versus a foreign tax credit, 99 times out of 100, I'm going to take the foreign tax credit because it is far more valuable. So depending upon the actual item that we're talking about, it can be much more valuable by doing it that way. So the first group of tax credits we're going to talk about are non-refundable personal credits. So some of these credits, like the child tax credit, has a non-refundable and a refundable portion. You're going to see that also with the AOTC. For the non-refundable portion, it'll go up to $2,000, and that's for any child that's under the age of 17 that is classified as your dependent, and it must be, must be on your tax return and claimed as a dependent. Now, in order to do the $2,000 credit, there's certain requirements you have to meet. Number one, they have to be under 17. And number two, they have to have a Social Security number. Now, for most people in the United States, this is not going to be a problem, but we've noticed this like with foreigners. So, for example, you have somebody who comes to the United States. They're here to work for, say, 4 or 5 years because their company sends them over here. So they bring their wife and their 3 kids. The wife gets a Social Security number. The husband gets a Social Security number, but the kids do not qualify for Social Security numbers because maybe they don't have work authorization. As a result of that, what will end up happening is they won't get the $2,000 tax credit. Instead, they only get the $500 tax credit. And that's kind of, I'm going to be honest, that's actually pretty difficult to explain to people. Why is it my kids don't get a $2,000 tax credit when the other kids do? And, and it's kind of like, well, you have to have a Social Security number. Now, some people, they just kind of accept it and move on. And then some people, they kind of sit there and want to talk your ear off about politics for about 5-10 minutes. And that's kind of the nature of our business, unfortunately, but it is what it is. There is a phase-out amount. It used to be right around 130, I think is what it was. So most people in the Washington, D.C. area under the old tax, before the Pre-Tax Cuts and Jobs Act, did not qualify for the dependent care credit. Now, as a result of them bumping it from there to $400,000 for married filing joint, a lot of middle-class families here in the Washington, D.C. area actually qualify for this, which actually was a good thing for them. Now, one of the things that went away with the Tax Cuts and Jobs Act was the exemptions. Now, if you think about it, most people who qualified for the exemptions were usually at about the 28, 25, and 20. So they were like more like the 25. The 28% tax credit. So if you take the $4,000 exemption that they had multiplied by 25%, equals a $500 deduction off of your taxes per kid. So if you think about it, the $500 one, they didn't really lose anything. When it comes to the child tax credit, they actually get a better deal because you got the child tax credit, which is worth which is worth $2,000 versus the $1,000 before. And again, a lot of people in our area didn't even qualify for the child tax credit before, so this actually worked out really well for them. So I've had some clients that are like, "Oh, I'm really upset that I lost my exemptions." But then when I work this math out for them, they're like, "Oh, I didn't get that." And so that's something that I do try to tell people and all that sort of stuff. You have the child and dependent care expenses. So if you have a dependent under the age of 13, or if they are disabled dependent, what does it mean by disabled? It means they require constant care. If they qualify for Social Security disability, automatically a disabled individual. You also have, if it's somebody who has a major life impairment, so you have somebody that's in a wheelchair, pretty easy to say. If they have somebody that's missing a limb, pretty easy to say. So otherwise, it gets a little bit gray. Generally speaking, if they qualify for a type of Social Security disability, they're going to qualify for this. So it's not that much. And usually, again, this is kind of like love. You know if you are, and if you are, you're going to qualify for it. So I've only had one time in my lifetime where we had to actually look this up, and that was actually because the person had a temporary disability because they were basically down for, I think it was around it was about 3 or 4 years. And the partner wanted me to find out if we could go back and amend tax returns for this. In this case, it didn't qualify because of some unusual circumstances. But the question of the day is, what did I'd have to actually look up harder? Percentage of qualified expenses. Again, it's $3,000 for one qualifying person, $6,000 for two or more. So if I've got 3 kids and I put them through daycare, up to $3,000 a kid, up to the 2 kids. The 3rd kid, I don't get any deductions for. And then, the actual percentage is going to depend upon the AGI of the individual. So if your AGI is anything, and I think actually this probably goes to the next slide. It does. So if your AGI is anything above $43,000 or more, you're going to get 20%. Generally, which is kind of interesting because usually if your AGI is around here, more likely than not, and if you've got multiple kids, you probably are going to qualify for earned income credit, and you're going to have a lot of that stuff is going to wipe out tax liability anyways. But it is something that can help. And really, if you think about it, lower income individuals are the ones who struggle the most with dependent care expenses. So this is actually a good credit for them to be able to take. But of course, as a CPA, you're probably not going to run into a whole lot of that unless you're doing tax returns for a child of somebody who might be one of your clients. So we're going to talk about the AOTC. This is one of the first of the education tax credits that we're going to talk about. AOTC is available for the first 4 years of post-secondary education. Now, I want to stop there for a second because normal people would make an assumption that means, okay, if I'm freshman through senior, I get to take it. And that's not the case. The way the IRS works on this is that you can take it for 4 years straight. And after 4 years, you try to take it on the 5th, you're done. They will not let you do this. So you want to make sure that you're not taking this for more than 4 years. We have had sometimes where people don't tell us that. We take it and then it comes back. They say, sorry, you've already taken it for 4 years. You can't do this. Again, in my personal opinion, if you can show that you are not, anything above a senior, you should be able to take it. But again, that's how they wrote the law and that's how the IRS is interpreting and that's how it's going. That's to be education expenses and institutions only. What is an eligible institution? Eligible education expenses are pretty normal. I mean, it's going to be like tuition, fees, things that you have to buy as a result of it. They will not let you take housing as part of that. Now, institutions are a little bit more interesting because institutions that you can actually deal with, and forgive me here, institutions that you could actually be dealing with here includes and basically it's anything that is allowed to take title, and I can't remember the exact title, but it's education loans. They qualify to take education loans. So you think anything in the United States generally is going to qualify, if it's an education institution. The ones that most people don't realize are going to be foreign institutions that actually are able to take those student loans. And a lot of the really big ones, like I know Oxford does. There's several universities in England that I've seen that are able to do it. There's several universities in Canada that can do it. I think there's 2 or 3 in Japan that I've seen that can do it. So they're going to qualify. If you go to one of those universities in the first 4 years, you're going to qualify in order to be able to do this. Again, I want to look up the rules, make sure that you're following them. but I think it's definitely worth it. So you're going to be able to get 100% of the first $2,000 of the. I'm sorry. Let me go back. It's applied per student. So if you have 3 kids in college, 3 kids qualify for the tax credit individually. So this could be like one of those times that having twins and maybe or even triplets can actually not hurt you. Whereas if you've seen the tax code, usually it's only up to a certain amount of kids. This time they actually say no, it's per kid. They're going to let you do it. It's taxpayers, taxpayer dependents, third parties on behalf of taxpayers, dependents, amounts paid by dependents treated as paid by taxpayers. So if you have a client and they claim the child on their tax returns, and the child goes ahead and pays the tuition and fees, it's deemed that the parent actually went ahead and paid that because the parents are actually solely responsible for those individuals. This is one of the few times where cash doesn't necessarily flow to who actually cuts the check. It's actually going to be dependent upon who claims who is a dependent. So they claim themselves, they get to take it. If it's by themselves, if the parents take it, then the parents get to claim it regardless of who paid it. Now, it's going to be 100% of first $2,000 of educational expenses and then 25% of next $2,000. Total credit is $2,500. It is phased out at higher AGIs. And this is where we run into issues in the firm is that most of our clients don't qualify for this, and their kids go to Boston University or whatever, and they're trying to get these credits, and unfortunately their AGI is usually just too high. Now there is an option where you can get the kid to take it, but what ends up happening is the father has the eligibility to take the dependent, but the kid has to follow it on the tax return. It's a little bit complicated, a little bit more technical. If you have any questions about it, I'm happy to explain it to you. We used to do this at KPMG every now and then, and so I know a way that we've done in the past. You also have the 40% of credit is refundable. So if you're on your own, you're trying to get yourself through school the first 4 years, this will be a good credit for you to be able to use. And we talked about this in class, and hopefully you guys get to use it if that's the case. We also have the non-refundable lifetime learning credit. So this one I've actually used several times because I'm a doctoral student and when I got my master's. It's 20% up to $10,000, maximum of $2,000 of the credit. There is a phase out for AGI. Again, you want to make sure that you're following the rules on this, but it is applied per taxpayer, and that is also very important. Includes professional or graduate school. It also includes continuing education. So, for example, if you decide after you get into the accounting world and you want to take some continuing education, but instead of doing it at a continuing education course, you decide to go back to university and take some accounting courses, you can use that as an education expense, go against lifetime learning, but at the same time, you can also use it for your for your continuing education requirements as a CPA. So that's actually pretty helpful. Very good credit. I've actually used it several times, like I said myself. Education credits, if you deduct for AGI, you cannot take the education credit. Basically, if you use $1 for any one of the credits, you can't use that same dollar for some other type of credit. You can't double dip, is what they're trying to say here, and that's what's important. And usually what will happen is most of the time in the tax return software, you'll tell them I have this much in education expenses. You'll say optimize. It'll run the calculation several times. It'll say, this is what we recommend that you actually do. Usually it's AOTC followed by lifetime learning, followed by the deduction, but it could depend. You could have some situations where they've got significant medical expenses, and as a result of which the deduction's better. I mean, it's something that you probably want to run that way. So then there's the refundable credits. Now I want you to understand, there are other tax credits that you can get that are non-refundable. There's a lot of business tax credits. There's a lot of there's actually some other tax credits. Retirement savings credit. We don't talk about a lot of those in the class because more often than not, people that are at CPA firms aren't going to be able to use those. So just to let you know, there are other credits, but we just focused on the ones that are important. Again, refundable credits. So we call it a negative income tax. You have to have earned income, and you have to have at least one qualifying child, or must be at least 25 years older or older. So if you're like a single parent, with 1 or 2 kids, don't make a whole lot of money, you're probably going to get this. I've actually only had maybe 2 or 3 times where I've had clients that actually qualified for this. I actually had one that qualified for this. No kidding, true story. I think they realized their business was going to lose money at the year, so they shot off their payroll in their S corporation. They only paid themselves like $20,000. They had them and then their 2 kids, and they lived off some money that they had received. But what had happened, because they had a lot in savings, the business didn't do very well for a year, and so as a result of which they actually got earned income credit, which was kind of weird because I was like, I look back at their tax return like 3 years ago, they made like $1 million. But that's just kind of how this worked out, and so it can happen. So this is how it ends up working out. I'll let you kind of just look at this on your own if you want to go ahead and hit pause at this time and take a look at this. Again, we don't see this very often in the CPA firm, so I don't really talk too much about it. And again, this is, so the previous slide was if you're married. This slide is if you're not married, and all that stuff. Business tax credits, like we said, it promotes certain behaviors. If credit exceeds gross income, you can carry it back 1 year, forward 20. Very good example of this is if you get a tax credit for solar panels, putting solar panels in your business. So like I have an S corporation. We're here in the office. Say I own this building, and I said I want to put solar panels on the top. I could get a tax credit, I believe, up to 30% that it would actually go on my business, and then I would be able to say, okay, it's something that benefits me. So we're trying to encourage people to do green things. Green is I'm wearing the green Mason sweatshirt, but that's kind of how that ends up working out, and so that's what they're trying to do. You can also have a foreign tax credit. They put this under business credits, but to be honest, it's not just business credits that actually get foreign tax credit. There could be some business foreign tax credits, but then there's also some individual foreign tax credits. This carry back forward 10 years is applicable for everyone, individuals and businesses. Usually you're supposed to take it back one, unless you make an election to take it forward for 10. The tax return program will actually track this for you, so just make sure that it makes sense. Is something that's important, but don't stress too much about it. So again, here's, and this is actually a very common question that I get here at the firm and for other firms I worked at. What's the application of business of credits? You've got a non-refundable personal is going to be done first. If it's an excess credit, it's going to be lost. You have business. If I'll be applied second. So say, for example, I have tax liability at $10,000 and I have a non-refundable credit for $5,000. Use that $5,000 first. Then I go to a business credit and say that's another $10,000. Well, I'm going to use that to wipe out my tax, but then I'll carry back one or forward, depending upon what my situation is for the rest. And then if at that point I have any refundable tax credits, I get to take those immediately as is. That's why if you have a non-refundable AOTC credit, but the AOTC credits, the non-refundable portion wipes out your tax first, the refundable portion will take over afterwards, which is actually very useful to have because I've had a lot of questions about that in the past. All right, so prepayments and filing requirements. Tax has to be paid as you go. Now, with most people who have wages, this is not a big deal because it'll be withholdings throughout the year. So the IRS gets their money now, and then you just file a reconciliation report, commonly referred to as a tax return. If you're self-employed, that doesn't necessarily work that way. So the IRS wants estimated tax payments throughout the year. And so what we do is we do quarterly payments. The software will calculate them, but you can change them based upon what your client's situation is. So you'll have it where it's, the first one will be due April 15th. If you think quarterly, you're thinking March, June, September, and December. The IRS changes those for a variety of reasons. So the first quarterly payment, they moved to April 15th. And more often than not, the main reason why is because most people haven't even filed their tax returns at that point. And since that's what's used in order to make a determination as to how much your estimated payments are, they give you until April 15th. And so that's one reason why they do it at that point. June 15th is the next one. September 15th is the third one. And then fourth quarter, instead of hitting it in December when people have holiday seasons going on, all that sort of stuff, they went ahead and they changed it to January, so it would be a little less of a burden on people. Although my personal opinion is that if you're spending tax money that you're going to remit to the IRS on Christmas presents, you probably have a problem. But again, that's what they do, and I get why they do it. Under underpayment penalties, you have the safe harbor provisions. So if you withhold 90% of current tax, or 100%/110% of last year's tax, you are not going to incur any of these penalties. Now, That doesn't mean that you get to the end of the year and you just make a massive payment in January and say, okay, I've withheld that all that needs to be done. This will be calculated on a quarterly basis. They'll say, look, your tax liability from last year was $100,000. So we're going to take that, and we'll say that you're under the 100% thing. We're going to take that divided by 4, and then every quarter you have to have $25,000 withheld. And for every quarter that you don't have $25,000 withheld, we're going to do an interest rate calculation to figure out how much you owe us. I've had clients, some of my clients, they don't care about this, and I have some of my clients that are so religious about this that they want to have a conversation every 3 months to talk about their quarterly payments. You'll have both. There's no way around it. Now, if you get to the thing and you've withheld at least 90% of current year tax liability, you won't have any problems. Again, that is calculated on a quarterly basis, so you want to make sure that you are following that as much as possible. So getting to underpayment penalties, this is kind of how much they are. So, like 90 divided by 4, 22% of current liability must be paid by the deadline. Penalty is the amount of underpayment at each quarter at the federal short-term rate plus 3%. I think right now it's about 2%, so a total of 5%. And that's actually, again, most of the time the tax software is going to keep up with that. You don't have to worry about it. But sometimes you need to look that up because I've seen where tax software is screwed up. We actually had a situation where we were trying to fight something with Maryland. They said, yeah, you used the wrong rate. And I'm like, what are you talking about? And I went back and I looked at the rate, and I'm like, yeah, the software was wrong. So anyways, sometimes you want to be able to do that. Filing requirements. You do have to file you do have to file a tax return if your gross income is over a certain amount. It'll base on the filing status and age. Again, the due dates are 15th. I don't think most people have a problem with this. The extending for filing up to 6 months. One thing I do want to say about this. Extending a person's tax return has no harm to them. You don't even have to ask their permission. If I want to, I could walk into this room right now and I could extend every one of my clients without their permission, and legally there's nothing wrong with that. Because it provides no harm. There's no harm to a person's tax return getting extended. If they file still before April 15th, the IRS isn't going to even care that they did an extension. Okay, so that's kind of the thing. And in fact, many firms that I worked at, February 1st, all businesses got immediately extended. No questions asked. So that was actually something that I thought was just very interesting. And I actually, quick story, I did have a client who got really, actually she was not a client, she was a prospective client, sent me her tax returns, we got her set up, she didn't give me any of her documents, I tried reaching out to her, she didn't answer, reached out to her again, didn't answer, and I said, gosh, we're getting close to April 15th, I'm going to go ahead and file an extension on her behalf. I filed the extension, and I sent her an email saying, hey, I went ahead and I filed an extension on your behalf. Whenever you get your documents to me, don't worry. 5 minutes later, I get this phone call, which tells me that she was probably ignoring me the first time. I guess what had happened is she thought she was going to go with me, ended up going with somebody else, but didn't have had a fear of telling me that she was going with somebody else, which I've never quite understood. My personal opinion is, if you're going to tell me you're not going to hire me, just tell me. I mean, I've got hundreds of other clients. I don't need to worry about it. But she was afraid to tell me that. And she called me up. She threatened me. She said, I'm calling the CPA. So first of all, she said she was going to call the CPA Society and have me sued, which I was like, yeah, go for it. Because anybody who knows anything about the societies, CPA societies aren't responsible for your license. It's the Board of Accountancy that is. Now, they could go to the Board of Accountancy and threaten to take my license. It wouldn't have amounted to anything. It is what it is. But the fact of the matter is that it is there is no harm in doing this. Had she tried to threaten action, they would have, I think the Board of Accountancy would have told her, look, he actually did you a favor. I know you don't believe that, but we're not going to take any action on him. I've shared that story with actually a couple people who do actually work for the Board of Accountancy. They kind of chuckled. So I feel nothing would have happened with it. Again, taking care of your clients is never going to be seen as a bad thing, particularly if it does them no harm. Now, releasing a tax return without their authorization, that is a crime. You cannot do that. So know what your limits are as far as what you can do. So late filing penalty, 5% of tax owed up to 25% if not fraudulent, 15% if fraudulent, up to 75%. No penalty is if the tax owed is as of the due date. So, for example, let's say for example you want to get out and you want to pay. You're going to file your tax returns. You realize you don't have enough time to get all the tax returns prepared. So you call the client up and say, look, I'm doing a rough estimate on a bar napkin. It says you're going to owe about $10,000. Cut a check to the IRS for 10 grand and all that sort of stuff. You get done with their tax return and you actually calculate it's not 10 grand, it's actually 9 grand. So they're going to get a refund of that $1,000. More importantly, because they made that payment prior to you actually going out, now of course you get an extension because you want to make sure you get an extension. The IRS is not going to penalize you for the fact that you made that payment. In fact, they're going to say that, because the tax was paid on time. Even though the filing took place later on, they're not going to pay you for it. And generally speaking, what they're going to do is that they're going to say, look, when we calculate these penalties, late payment penalties and late filing penalties, they're always calculated based on how much was due on the specific date. Okay? So if you owe, say you were supposed to file your tax returns on April 15th. You don't file them until May 15th. And you forget to do the extension, but your client makes a payment for $10,000 by April 15th. Okay, you calculate the tax return, they owe $9,000. They will not pay a single dollar in late filing penalty or late payment penalty because they didn't know anything. Okay, even though you messed up and you forgot to do the extension, they don't owe anything because it was paid. The thing that you're going to run into is where they don't make that payment and then they owe a whole bunch of money because either an extension didn't get done or a late payment actually took place. And late payment is probably more common than others. And by the way, just to let you know, the payment penalty and the late filing penalty are the ones the IRS actually has more ability to negotiate on. This is their penalty. They're able to charge it because of the law, but they don't have they can waive these penalties if they want to. Interest, on the other hand, can't do. They have to if you don't pay your taxes on time, they have to charge you an interest charge, and Congress mandates it. The only way that the IRS can do that is waive it is if they were the responsible reason why the mistake was made. So, for example, I filed my tax return. I have proof that my tax return was filed. They lost it. They can't come back and charge me interest as a result of this. They lost the tax return. So that's one reason why this would actually happen the way that it does, okay? So combined late filing and late payment penalties may not exceed maximum amounts for either one, and that's true. If you go back to the previous slide, you'll notice that there is a maximum amount. It's up to 75% if fraudulent or up to 25% if not fraudulent. And then it's 0.5% of the tax owed for each month that the tax is not paid. That actually, and again, if you want to talk about the nasty one, is this late filing penalty. The late payment penalty is worse than the interest, but not nearly as worse as the late filing. I've seen where late filing, is gargantuan huge because people don't do it. And I've had a couple clients that things got behind them. I mean, I have a client right now, didn't file on time. I know he's going to owe a ton of money. And I'm going to have to explain to him, if you paid your money when we told you to pay your money, this wouldn't have been a problem. So that's something that ends up being a little bit of a concern. All right, so that's all I got to say for this video. I want to say thank you very much, and I look forward to seeing you guys in class.